Okay, perfect. Okay, brilliant. So we'll get going. So good evening, ladies and gentlemen. Welcome to our very first socially responsible investments event, which can also be known as ESG, or Environmental, Social and Governance Investing. My name is Sarah Nesbitt, and I shall be your host for the evening. And I am one of the investment consultants here at Moneyfarm. So as many of you may know, or not know in that case, is we have actually just recently released our socially responsible portfolios. So this is an area of investing that has been, a big trend as of lately or the last couple of years. And also with this kind of brings a new area of opportunity. So we at Moneyfarm have developed our own approach, and we are here tonight to present that to you. The format for the event is that we have 3 speakers, an introduction from Moneyfarm CEO Giovanni Daprà. We also have Richard Flax, our Chief Investment Officer, who will go into more detail about our socially responsible investing approach. And last but not least, we also have Chris Rudden, our Investment Consultant Manager, who will talk about how to integrate socially responsible investing into your wider investment strategy, and also that key topic of performance. As usual, we do also have a Q&A session to answer some of your questions. This will be at the end of the event. But you do have the ability to submit your questions via the chat function in the Zoom, which our team of investment consultants will be on hand to answer as many of those questions as possible. So during the live Q&A at the very end, we will pick some of your questions to answer and propose to our speakers. Also, one last thing, if you do end up dropping off the Zoom, do not worry. We will be sending a recording of the event in your follow-up email, along with some extra details and also a link to be able to book in an appointment to go into more depth into this topic as well. But let's get started, and I will give the floor to our first speaker, which is our CEO and co-founder, Giovanni Daprà. So over to you, Gio.
Hello, and thanks everybody. Thanks, Sarah, and great to be here and talk about our new ESG offering. I would say the first point was just to say why we decided to go on the path of creating an ESG offering. And I think for us, the real reason is that we do think that we need to put our capital and our customer capital in a better place. We do live in a very risky world today, which is almost an emergency, I would say, where we have rising temperatures to the point that we not going to be able to control what's going to be the outcome for our planet. So it's really important for us as a company, as a business, that we start to focus more of our attention into helping and supporting as much as possible this current crisis. If we think about return and whether ultimately this will be a proposition that will change the return profile for our customer, I think this is something that, of course, is on top of our customer mind and agenda. And we don't really think there is a trade-off between the long-term return of our traditional portfolio in ESG. If anything, they might be better, but we do think that ultimately those propositions will converge. So it's really important to understand why we believe we recommend to our customer to invest in ESG. It's not just about return, but it's really about making sure that the positive externalities that are basically driven by the allocation of capital to companies that favors and have a stricter ESG criteria are really why we believe that our customers should put their money today in an ESG portfolio. And we just started as a journey of a company, but we're gonna really looking to continue to basically make sure the ESG become the core of our proposition. As I was saying before, the key reason why we stepped in and also answered to the customers and your request of having such a solution is it's about climate. and really we think that is the biggest problem to solve. So the way we built the portfolio, and Richard is gonna explain to you a bit more in detail, is really around a strong focus on environmental protection. And we really didn't want to take any shortcut in making sure that the funds and the ETF we selected were the best in class around that. Finally, as a last step, before I hand it over back to Sarah, today we will be really happy to guide you personally with our investment consultant through the proposition and how it has built and why we think it's an outstanding product, and why particularly we manage consistently to get a better outcome for our customer, also on the ESG front. We have working extensively to put a methodology on paper that allows us to be transparent and very precise in the way we're gonna run this portfolio, which we're gonna send you in an ebook version if you want to drill down into the works on Richard and the team and how we make those selections. Lastly, enjoy the event. For us, it's always a pleasure to showcase what we built, and we do hope you find it informative and helpful to make your informed decision. So thanks a lot, everybody. I'm gonna be here to answer any question, and I leave back the floor to Sarah.
Perfect. Thanks, Gio. And yes, just to reiterate what Gio has said, you will be receiving a follow-up email. In that follow-up email has the link to book an appointment with one of our dedicated investment consultants. So if you do submit any questions via the live chat and they don't get answered, or they don't get answered by the speakers, highly recommend booking an appointment, and we'd be more than happy to kind of go into it in more depth at a time that suits you. So yes, if you want to go ahead, there's also the Q&A function on the Zoom. So do not worry. Oh, looks as though we've got our first question in the Q&A. So yeah, so keep them coming. We love to hear from you directly. So what I'll do now is I will pass you over to Richard Flax, our Chief Investment Officer, to explain a little bit more about the actual social responsible investing approach that we took. So over to you, Richard.
Thank you very much, Sarah. Good evening, everybody. So, you know, look, a couple of things that just at the outset, you know, what do we mean by socially responsible investing? You know, as Giovanni has mentioned, it's a broad set of criteria, but we've skewed the focus a little bit towards the environmental side, and that's affected some of the choices that we've made in terms of the ETFs that we've selected and the way that we've constructed these portfolios. And so what I'm going to try and do this evening is drill down a little bit more detail, talk about how we've built these portfolios, what some of those choices are, and perhaps importantly, how we think this type of product is going to evolve in the future. Important to remember that while ESG has been around for a little bit of time now as an investing concept, it continues to develop, particularly around the data side, and that has some implications about the choices we make today and potentially the choices that we make in the future. First, a little bit of context. This is from the World Economic Forum's Global Risk Report, and the message really here is perhaps it doesn't need repeating, that, you know, particularly on the environmental side, you know, the consensus view is this is an increasingly important issue. Giovanni alluded to that at the outset, and you know, and the message here is that amongst this group of opinion makers, you know, the likelihood of it being a significant impact and the impact that it will have both increased significantly in recent years, and that has only been exacerbated over the last 12 months, particularly during COVID, has very much focused public attention around this, and more recently around COP26 in Glasgow. So when we think about you know, the impact of that, it's obviously not just at a social level, it's also at a policy level. And this particular chart from the UN really highlights the number of policy interventions that we've seen, you know, and that has steadily increased in recent years. Inevitably, you will see a lot of people perhaps suggesting that it hasn't gone far enough or fast enough, and that's a fair point. But perhaps most importantly for us as investors, at some point it almost ceases to matter whether or not you believe in ESG as a concept. What seems, we clearly do, but what seems clear is that it is becoming a meaningful policy risk, a risk that can have an impact on investments, particularly in certain sectors. And that's something that we need to factor in as investors, almost regardless of any philosophical view around ESG or ESG investing. So when we started thinking about this, the product and how to construct it, and it took a little bit of time, we asked ourselves the question: what's the right level of ESG integration? And what you see, and this chart is a little crowded, but what you see is that there are actually a fairly wide range of approaches that you can take particularly within the ETF universe, but also within the public market universe. And in some cases, you can go for something that's relatively limited, that simply screens for values, maybe does a little bit of negative screening. But if you look at that, the second row from the bottom, the ESG quality score, you see it's not very different from the underlying parent index. And we philosophically took the view that if our customers were going to invest in ESG products, they would want them to look materially different from the classic portfolio. And so when we thought about what level of, how stringent the ESG or the criteria should be, we focused on the more stringent criteria that were available in terms of the product offering. And if you look at it on this slide, you see it slightly differently. On the y-axis is a scoring mechanism in terms of ESG, an ESG score, or ESG risk score, higher being more ESG. And on the x-axis at the bottom is the tracking error. In other words, the difference that index has relative to the parent, in this case, MSCI World Global Equities Index. And for us, our preference clearly was to go for the top right-hand corner, the SRI type ETFs that followed a more stringent set of criteria, really embracing the difference that you would potentially see, for better or for worse, in terms of the difference in performance between that index and a standard equity index. So when we put the Moneyfarm portfolios in context, what you see is that if there's a continuum, as it were, between a pure financial investment on one side and then what's called impact only, where you invest without a regard to the financial return. And we, these ESG portfolios at this point sit within the responsible investment, so still in the public market equity space, with relatively stringent criteria in terms of the types of indices or ETFs that we invest in, but not yet, and not by design, at perhaps the more impact stage. And when we think of impact investing, we typically think in terms of companies that are perhaps not yet listed, where there's perhaps much smaller, much riskier. And so far, that's not where we've positioned these portfolios or the Moneyfarm offering generally, which is very focused on liquid public markets. But when we think about how we're going to potentially evolve the offering generally, we do think there's an opportunity in some satellite strategies to potentially include some impact investments. And we're thinking about the right way to design an offering that can provide that, and work with partners to provide some perhaps very interesting, less liquid investments for those clients for whom it's appropriate. So now let's turn a little bit to the question of how do we build these portfolios? And I would say that the first part is that the core asset allocation process is very much the same as it would be for the classic portfolios. So when we think about asset class returns, when we think about the relative attractiveness of bonds versus equities, that sort of asset class research is very much the same. Where the difference comes to is really within the ETF selection process. And for the ESG ETFs, we start with a standard approach. We think about the financial quality of the ETF in terms of how much the expense ratio, how much it costs to trade, how the ETF is constructed. And then really we go on to, to analyze it from an ESG perspective in terms of the quality of the data, in terms of the sort of restrictions that the particular underlying index uses. And the advantage here is that we think we can get some fairly good data in terms of assessing at an aggregate level what this means. And we'll show an example of that towards the end. But we think about it at a corporate level in terms of debt or equity, at a sovereign level as well. And we select our preferred ETFs and then think about building portfolios based on those ETFs, which correspond to the risk parameters of the classic 7 risk levels that we have. So at the end of that, we can look back and say, okay, well, this ESG portfolio has this set of ESG characteristics, but also from a risk and return perspective, it's in line with what we would have expected under sort of traditional financial metrics that we apply. The other thing that's worth keeping in mind on one of the questions that came up was, okay, well, if a lot of ETF providers are using similar benchmarks, similar indices, how do we differentiate between the different providers? And one thing that we spent a lot of time looking at was really around voting policies. Because while they may sometimes use the same indices, they may not have the same views around voting. And sometimes there's a little bit of a confusion, but just because an ETF issuer, ETF provider is using a passive strategy or an index strategy, that doesn't mean that they're not engaging with corporates in terms of voting on AGMs and on particular issues. And so we did a good amount of analysis to try and understand within an ESG framework how different issuers behaved. And when we thought about our ESG scoring, we weighted our ETF exposure to those ETF issuers where we thought the way that they voted was consistent with some of the ESG criteria that we were looking for. It also gave us the opportunity, to be honest, to engage with some of the ETF issuers and talk about our results and get feedback from them and really engage with them. Hopefully to sort of be a small voice for change where it was appropriate to say we'd like to see a more active approach, or we'd like to see a greater focus on environmental voting on environmental issues, whatever it happened to be. This is a sort of scoring that we will do on an annual basis, and we look forward to doing the next one in the next couple of months. But we really thought it was a way to try and differentiate between different ETF issuers. So then the question is around, well, what's the impact? And we're using MSCI data here, but one of the advantages of that was that we thought we could get a reasonably good idea about what the difference was in terms of things like carbon emissions, as we see on the left, between a classic portfolio of a particular risk level and the ESG portfolio. And it's relevant because there's been a lot of talk, and there continues to be a lot of talk about data. And what we see is that while there have been significant improvements in terms of ESG data quality over time, there continues to be much more work to do. And there are a range of opinions depending on which data provider you talk to in terms of how they evaluate different companies. And some data providers will score one company relatively well, another data provider will score the same company relatively low, depending on the criteria that they choose. And we would expect that, I guess, at this stage, but we would also expect to see a gradual sort of coalescing, as it were, of opinions as data improves, as thinking about ESG improves, and as different sort of emphases in terms of how you evaluate something between the E, the S, and the G, how that begins to play out. But we do think that having good data, having companies report well is critical. And we would also continue to expect to see regulators take an increasing interest in this and begin to mandate a bit more precisely the type of data that they expect to see from companies. And that's something that transparency that we can share to our clients, we think is something that's very powerful to help people understand, the difference that it makes, but also understand the limitations of where we are at this point within the public market space. So if you think about how this, how the portfolio will develop today, we think we've got a very robust process, a very robust product, but we also think that we're at the start of a journey. We think that we're going to continue to evolve and develop these portfolios as data improves, as new products become available. We're quite excited about the potential that we could have within perhaps a core satellite structure to provide more impact opportunities to those clients for whom it would be appropriate. But we thought it was very important to take that first step to launch these products, and then really begin to engage with our clients, with ETF issuers, and with the market to try and move this discussion forward. So that that's really the key points that I wanted to make. And with that, I'd like to turn it back to Sarah.
Perfect. Thanks, Richard. Really, really insightful. It's really interesting to kind of get into the nitty-gritty of how the actual approach came to be. So yeah, certainly, with that also comes quite a lot of information and quite a lot of depth that we did go into. So what you also have in your follow-up email after the back of this event is actually our socially responsible strategy document. This document is really quite comprehensive, so definitely give it a little look. And of course, if you do have any questions, you can certainly book in an appointment with our team to kind of go through it together. But yes, so thirdly, we move on to Chris Rudden, our investment consultant manager, and he will take you through a little bit more about that. So over to you, Chris.
Thank you, Sarah. Good evening, everybody. Just a short section on me at the end. Ultimately, most of the meat and drink was covered by Richard in terms of what it means, what we've done as a company, and where we've gone. But a couple of questions that we always get from clients around this is, okay, how does it fit in? How do I use this? What does it mean to me? So if we have a look at the next slide, is ultimately nothing really changes. So for somebody who is investing, there are several steps to consider first, and they are fundamentally the main things to consider. First of all is obviously suitability. So obviously there are some existing clients on this call, some new clients, some people who have not heard of us or haven't signed up yet. But essentially, as part of the process, you may have been aware that we'll ask you to go through a risk questionnaire. This is always fundamental to find out what is your risk appetite. And ultimately, I feel like investors, sometimes they never appreciate this. They might want to go for something high performing, but they suddenly realize they can't stomach the downturns when the downturns come. Some people go in safe when maybe they actually could have, had more returns in the longer run. Ultimately, the key is first and foremost to understand what risk level is most appropriate for you. Then obviously from there, having a kind of a profile of yourself, you can then have to understand what your goals are when you're investing. This is key. Some people might have the idea of buying a house in 4 years. They might also have the goal of investing in about 25 years, for example. These two will have a very different risk profile, kind of a different asset allocation, which is appropriate for this, like a combination of investments, which is different. For example, the shorter time frame will generally be safer, less open to market volatility of the equity markets, whereas the longer term portfolio will be kind of more heavily weighted towards equities. So obviously a higher allocation to stock markets, which tend to generally outperform, at least historically, in the long run. However, obviously having the time frame allows you to ride out the ups and downs which come with the equity markets. Obviously the next step, a bit more simple, but essentially, am I investing for the longer term? Should I have a pension? Am I in the midterm? Do I want to be tax efficient? Am I eligible for an ISA? Or have I filled my ISA allowance? Do I need to invest into a general investment account? These are obviously all relevant questions when making the investment process decision. And then at the last stage, that's when ultimately you then choose, okay, now that I know what risk level is right for me, what goals I have, which product is most appropriate for me, you can then decide, look, well, how do I want to actually invest as well? And as Richard alluded to, particularly at Moneyfarm, but everywhere else, you'll have like for like risk levels where it will be kind of ESG versus kind of more of a classic approach. So again, for example, at Moneyfarm, you'll have a level 7 ESG portfolio and level 7 classic portfolio, both of which, in terms of a risk return profile, should in the long run have a very similar, at least risk profile, and then obviously returns should follow suit as well. So that's how the process should go, and that's how you should fit it in ultimately into a plan. We get a lot of people who ask, I've got this, should I just get a random ESG portfolio on the side to, see how it goes, see how it runs? Obviously that's one way of dipping your toe in the water, but fundamentally the key is ultimately to invest towards a goal. And that's what's the best way of going about it is, and that's how ultimately we should do it. Obviously you can then choose to do both. So what we find is it's still very early on in our journey, but 52% of our clients who have an ESG portfolio have switched their entire account and they are entirely ESG. Whereas we have 48% of these people who still, they'll have one of their goals, one of their portfolios set up as an ESG portfolio, one's still remaining in their existing classic. Or obviously if they're new customers, they can choose one or they can choose both. And ultimately that gives you the flexibility to be able to do that. Again, if you're an existing customer and you want to talk about how to do this, obviously please feel free to get in touch with our team after this. Next slide, please. So Richard's touched on the main things in terms of obviously what it means for an ESG portfolio, how we've gone about it, the metrics that matter, carbon emissions, etc. However, one question that we always get, which we can never kind of escape from, which clients are always interested in, is which one will perform better? Will ESG perform better? Will my classic perform better? If I'm sacrificing, doing a good thing by investing in ESG, will I suffer financially? The short answer is ultimately we don't believe that is the case. We set our portfolios up to be matching the same risk levels, matching the same kind of volatility targets, and making sure that we have the same approach to how that we build the portfolio in terms of our expected return calculations, building the portfolios to fit those and to maximize those. However, in the shorter term, you will find probably some fluctuations between the two. Touched on only a handful here. I'm sure there's a few of you kind of screaming at the screen saying I've missed a few, but ultimately there's a couple of points really is more on the ESG side, particularly in light of kind of COP26 and more of a global focus on these things. You hear the term net zero being thrown around quite a lot. Ultimately, that will start to feed into companies as they aim towards to get these targets or possibly forced to try and reach these targets. So obviously, if there are companies which are ahead in terms of either, kind of restructuring their business, restructuring their supply chains, restructuring their own kind of way of doing business to be releasing less carbon, for example, that will already be a way of going ahead. Whereas those who haven't, potentially further down the line, may have to purchase more carbon credits, this sort of thing, which ultimately might affect the performance of the company in the short term. Other factors, things like consumer behavior, we already see shifts not only in the ultimate product themselves, so obviously electric cars, people moving away from fast fashion into more sustainable fashion, but ultimately there are companies which kind of set themselves out to do well, certified B corporations, and they essentially, people will buy products from them because ultimately they know that they are doing, in this field and doing well and making a difference environmentally. So these little things might be in favor of ESG outperformance, and possibly in the long run, you'd think there would be a shift. And then obviously, kind of regulations, subsidies from governments, this sort of thing will likely, as Gio alluded to at the start, with the shift and the focus that's coming this way, likely to come more and more from governments. So we think that these would kind of help at least ESG related portfolios, companies in ESG indexes to do well. But obviously on the flip side, there are some reasons why they might not, and potentially slightly more focused, slightly less diversification. But ultimately, I think in the long run, we don't think that there is a difference, a choice to be made. And if Richard touches on the next slide, just to show you visually, there is a spike at the end, which is on the SRI index, which is almost completely attributed to Tesla. But apart from that, what you can see there is there's a lot of kind of the dotted line in the middle, which is along 100, is the performance of the MSCI World kind of index to 100, and then above and below is whether these particular ESG or SRI indexes have outperformed, underperformed during that period. When they are above the line, they have overperformed. When they are below, they have underperformed. As you can see, there or thereabouts, barring the anomaly of the yellow line, more or less all of them seem to bounce around in the shorter term, but generally trends towards the MSCI World in the midterm. So again, just going all the way back to that question about which one will perform better. Do we think the ESG will be better? Am I sacrificing performance? Ultimately, we can never predict the future, but we don't expect there to be a huge difference. We don't expect people to have to sacrifice performance in favor of kind of doing well, so to speak, making a difference and being more responsible with their investments. Just on the last pitch on the slides, what can we ultimately do for you? So ultimately, we have a team of investment consultants, very qualified, very well educated, very lovely. If you've ever spoken to them, they are always on hand to answer any questions that you have. So obviously we've covered a lot of topics here. And if you wanted to go more in depth on a one-to-one basis, we're always there to help. So we will be sending out an invitation link, I believe, possibly in the chat function now, but definitely afterwards in the emails. And obviously it's always available on the website. So if you ever want to talk through things in more detail, please feel free to reach out. It's free, obviously. There's no need to worry about anything. It's highly accessible, and we're always more than happy to help. Again, touching on things, obviously, if you're an existing client, you can set up a new ESG portfolio alongside your existing portfolio. You can switch any existing portfolio that you have. There is no extra cost to any of this. It's always available. It's just as though it's an added portfolio selection available on your dashboard. So if you need a hand, if you are interested in making a change, you can do so from within your platform now, or you can speak to us about it and find out a little bit more. But yeah, that's it from me. Thank you.
Perfect. Thanks, Chris. Thanks so much. Okay, so brilliant. All right, so now we're over to the Q&A portion of the event. We've had quite a lot of questions submitted through our function on the Zoom. So what we'll end up doing is just going to select a couple and pose them for our speakers. So from here, if we get started, let's have a look at what the first question could be. Okay, brilliant. So we've got a question here, one that is a little bit more targeted towards Moneyfarm ourselves, and really is what are Moneyfarm doing as a company to be more, ESG, socially responsible in that way? So I think I'll hand that over to Giovanni to answer that one.
Thank you, Sarah. So we're doing a lot of things, and it's of course is a process for us, and we've started in a couple of years ago, and starting, I will say, firstly from the employee, and really working on how we can improve diversity in the team, we can improve the governance, and we can effectively allow everybody to participate into creating a better company. But also we are looking very, very details of, for instance, Chris mentioned the B Corp qualification as one of the route to go down, and we are working also on the PRI, so being able to become signature of prudential regulatory investment, and this is kind of one of the activities that we are effectively working towards in 2022. So we'll say it's a journey for us. We are creating a dedicated resources within the company to focus specifically on that, with really the aim to start particularly around the beginning of next year with more, I would say, more effort around these topics, also including the governance of the company, which today it's to a certain extent we can really have a better impact in terms of ESG criteria. So it's a lot of things, and again, it's a journey for us, which we started about 2 years ago to really focus on these topics, and we're gonna probably continue to do that and take it to the next level during the course of next year.
Perfect. Thanks, Gio. So yeah, we've got a couple of questions really around, with this new set of portfolios, do they cost more? Do they cost less? And also, kind of how to be able to start investing in these portfolios. So I think I'll take this one. Really, with our new range of socially responsible portfolios, the price or the charge does not change whatsoever. So your charges are fully based upon your total market value on your platform. So actually, the more that you invest with us, over 10K, your annual percentage fees slowly start to decrease. Where it differs between our classic range and our socially responsible range is that our classic has an annual average of 0.2, whereas our socially responsible has an annual average of 0.21. It's not a huge difference, but your Moneyfarm management fee stays exactly the same. And is also charged the same. So if you did want to try out our new portfolios, you don't have to put all your eggs in one basket. What it is you can set up more than one pot. So with your ISA or your general investment account, you can invest in more than one risk level and more than one type of allocation. So you could have the classic range with portfolio risk level 4 and also our ESG risk level 4 as well. So we have all 7 available in the socially responsible range. And yes, you can have a split between both of them. But yes, so if we move on to, I think this is more a question for Richard. What this question is really about is, with the socially responsible approach and the criteria that we've taken, how does that apply to the bond portion of a portfolio? So, it's hard, it can be difficult when looking at governments versus companies to kind of determine how socially responsible they are. So in that case, how did Moneyfarm approach that? And how did we, look at them differently from governments versus companies?
Sure. So thank you for that, Sarah. Let me say a couple of things. Firstly, as you rightly say, when you look at the investable universe, or the ETF universe in particular, but also the fund universe, there's been pretty good coverage on the equity space. A good range of equity funds, equity ETFs, with ESG screens of whatever sort of strenuousness that you would like. There's been a little bit less on the corporate bond side. Just not as broad a range, I would say, and the government side is more of a philosophical question, and so our view has been a couple of things. So firstly, we decided that there are a couple of the industry is still trying to work out how to think about government bonds within an ESG context. Some of the work that's been done is really around the Paris Agreement, whether governments have signed up to the Paris Agreement. And this is more relevant, I think, for developed market government bonds than perhaps for emerging markets. We looked at some of those products. We didn't think that they were really differentiated enough to merit a change. But we did say that we would bias these portfolios to having rather more ESG corporate bonds, particularly on the investment grade side, and switch some of the government bonds that perhaps you see in the classic portfolios into the corporate space. So we don't have zero in developed market government bonds. We do have some, but we have significantly less than we do in the classic portfolios, and we've really replaced that to try and increase the percentage of the assets that are in demonstrably sort of SRI vehicles. We'll continue to see how thinking develops around developed market government bonds and how those screens are applied. As I say, we've seen some early efforts which didn't seem differentiated enough. But in general, the market is perhaps not still, even on the corporate side, not perhaps quite as well served in terms of the range of ETFs available as it is on the equity side. Sorry, that covered a couple of different points, but hopefully got the point across.
Yeah. No, absolutely. Thanks, Richard. So yeah, so if we have a look at some of the other questions, just taking a quick look. So kind of one of them was looking at around the ISA and investing in our socially responsible portfolios via the ISA. So does anything change by investing in this new range with the ISA? As well as, is there a difference in the profit and loss compared necessarily from our ESG or the classic, or by investing in an ISA or versus a general investment account? So I'll roll this question over to Chris to give you more information on that.
Thank you, Sarah. Yeah, I mean, ultimately, there is no difference in the rules at all. Obviously, you can still contribute £20,000 into an ISA each tax year, whether it's ESG or classic or a combination of the two. Obviously, you can have two different portfolios within the ISA wrapper. As long as your contributions between the two of them don't go higher than 20,000 then each tax year, then you're absolutely fine. I saw a question about switching. If you've got an existing ISA and you wanted to switch it to ESG, that's absolutely fine. The money's already inside an ISA wrapper, so it doesn't count as a new contribution. It's simply switching from an existing ISA to another existing ISA without actually money leaving or going out back into the ISA wrapper. So that's absolutely fine. In terms of returns, I mean, ultimately, we don't expect there to be a huge difference at all, particularly if you have like a level 5 versus a level 5 general investment account ISA. In the long run, once the portfolio builds up, you could argue that you could kind of save yourself a little bit of tax in terms of capital gains tax, dividends tax, etc., which will ultimately help towards your total return. So that will always be a positive. But apart from that, if you're looking to ultimately start the product from scratch, there shouldn't be a difference. So that shouldn't be a factor when making the decision between a general investment account and the ISA. Perfect.
Thanks, Chris. So just having a look at a few more questions. We've covered quite a range. So maybe another one to kind of hand over to Richard is, we get quite a lot of kind of comments about greenwashing with these new socially responsible funds. How do we take into account greenwashing? Do we care about greenwashing? Is it something that we've thought of before? And really, what is Moneyfarm's stance on it?
Sure. So look, I think greenwashing, by which we mean companies trying to dress up what they're doing to be more significant from an ESG perspective than it actually is. It is an issue, and I think the concerns around it have got quite a lot of press, which I think is good. I think it's good because at the end of the day, when we invest in aggregates, and we do invest in aggregates, we don't typically think about individual companies. We want to understand the aggregate impact, and we want to think about ways of improving that aggregate impact, and that's why I talked a bit about the value of having data that hopefully captures accurately the relative improvements that we can see in an ESG portfolio versus a classic portfolio. So I think that there are but there are always a couple of points to bear in mind. The first, as I said, having data, having well verified data, and having somehow standardized data is critical. And the sort of the momentum behind ESG from the general public, from investors, from regulators, and hopefully from companies themselves is moving us in that direction. And so I think the direction of travel is positive. Obviously, you would like it to be faster than it is, but I'm always somehow reassured to see the criticisms of greenwashing, because they just keep the focus on the issue, on having good quality data that accurately represents improvements that companies are or are not making. I think the second part is on the regulatory side, where to the extent that you can standardize reporting, that there's obviously will be talk around having sort of ESG reporting to match kind of financial accounting reporting, and having that standardization will make life I think easier and more transparent. And I guess so those really are the main parts. Clearly, greenwashing is, and sorry, the one more thing that I would add is I think we also need to be clear about the limitations of ESG investing in terms of how big the impact is. It's a reduction, it's not an elimination, at least at this point, if you think about it in terms of CO2. And so understanding those limitations and understanding concepts like best in class, when you think about how ETFs are constructed, in some cases where you may find yourself with companies that are better than their peers but still can improve. These are important considerations, and they matter to us a lot because we wanted to make sure that when we talk to our clients about the product, how we were building and what we were building, that we were clear about not just the impact that this would have, but also where we anticipated potential for improvement going forward. But at the end of the day, when you think about greenwashing, it is really about transparency. It is about consistency of data, consistency of measurement, and we are seeing progress on that journey, and hopefully that will continue to accelerate.
Perfect. All right. Thanks, Richard. Just kind of a follow-up one to that. So in terms of with our portfolios, so we have our classic and our socially responsible. Does it differ at all in terms of how we manage them? Do we manage them the same? And those kind of questions.
So when you think about sorry if I got it right there, if you think about the asset allocation process, they are the same. So you should expect that if we are, for instance, cutting equity risk in our classic portfolios, we should be cutting equity risk in the ESG portfolios as well. For instance, if we are reducing duration, if they start at the same level, you would imagine that we would be reducing duration in both cases. They are not precisely the same. Inevitably, they do take different risks, and if you disaggregate some of the equity exposure, for instance, between the two of them, then you will see sector differences as by design, right? You would imagine you will see rather less energy exposure in an ESG equity sleeve than you would in a classic equity sleeve. But in terms of some of the headline metrics, in terms of how we think about where we're taking risk, it's the same process. You may get different outcomes, slightly different outcomes in terms of within the nuances of how the portfolios are constructed in terms of sector exposure, country exposure. There are some, the obvious case is we don't have commodities in the ESG portfolios, but we do have some commodity exposure in the classic portfolio, and differences like that. But the debate around what to do is the same debate and the same process.
Perfect. No, it's always nice to get like a little bit more of a clear understanding of that. So I appreciate that. Okay, perfect. So I think that will conclude our Q&A for today. So thank you so much, everyone, for taking the time to join us this evening. Thank you so much for all of your questions. We really do appreciate it, and it's been great to have you here with us. If your questions did not get answered, please do book in a call with our investment consultants, or of course you can also reach out to us directly at moneyfarm.com, or you can also go through your own personal investment consultant as well. What will happen is whenever the Zoom actually ends, please stay on the line. We have just a very, very quick, very, very brief questionnaire. I believe it's only a couple of questions, just really on how you found the event. So we do appreciate you taking the time to complete this, as we always love to hear your feedback, and of course any improvements that we can make as well. So once again, I just want to thank you for attending. It's been great, and enjoy the rest of your evening. Perfect.
Thank you very much.
Thank you.
Thank
Thanks,
you.
guys.